Welcome everyone to our Builders IQ series. Today I've created a presentation on construction financing. I'm hoping this will just provide a good general overview of construction financing. We're going to discuss some kind of a wide range of topics from what we're looking at from an underwriting perspective, how loans are structured, as well as how loans are advanced and some of the intricacies within. So for those who don't know me, I'm Max Miller. I'm the AVP of Mortgage Lending here at Foremost Financial. I'm going to try to get through this presentation as quickly as possible. So if there's any questions, we'll save some time at the end, but if you have any other specific questions, feel free to reach out directly with the contact information listed on this slide. So yeah, any specific questions, if you're looking to discuss any specific deals, yeah, feel free to reach out. So let's get into it here. So who is Foremost? Foremost was established in 1987 by our principal, Ivan Stone. We focus on financing construction loans as well as development land and commercial and industrial properties. We've got a fairly tight geographic lending area, which is the GTA. More specifically, we're looking at Oshawa to the east, Barrie to the north, and Burlington to the west. We are currently expanding westward out to Hamilton at the moment, and there's a couple areas that we also like lending in, including the Tri-Cities, Kitchener-Waterloo, Cambridge, Guelph areas, and we've also done a few projects up in the Collingwood area recently. So we're always kind of looking to identify new markets to lend in. However, we do like keeping a tight geography just because we always like being within close driving distance to all the projects we work on. Total assets under management is over 275 million, and that's made up of our first and second mortgage fund. And our loan sizes range between $1 million and $20 million. And we do have the ability to take on larger loans up to the $30 million mark. So the Foremost advantage, I'm just going to run through these quickly here. I have seen during my time working at Foremost that a lot of our business is repeat customers, and I think it's a lot to do with some of the factors listed in the slide. So first of all, we've got the ability to make fast decision making as well as dependable decision making. So if you're able to provide us with the necessary documentation off the bat, we can typically get back to you within the day, whether we're interested in moving forward with the situation and kind of high level terms and fees that we'd be looking at, and dependable as well, just based off of our structure. If we issue a commitment, unless there's something major that comes up in the underwriting process, that deal will get funded. Again, fastest, dependable decision making, a major advantage for us. Another one is reliable source of funds. So all our mortgages are funded via internal funds. We don't rely on any other lenders to fund our projects. So once again, if we put a commitment out, we don't need to bring in another lender to get that deal done. We've got a first and second mortgage fund that fund all our loans directly. Creative solution to complex needs. So as I mentioned on the last slide, Ivan Stone, our principal, started this business back in 1987. So he's kind of seen it all. We've got a lot of internal knowledge in both strong and weak real estate markets. So we've really got the internal knowledge to come up with some really creative solution to some complex lending situations. And then again, big thing here is our focus on infill construction financing. Like, we've put together a very strong financing program specifically focused on infill construction. We've really carved out a niche in the industry, and due to the focus, we've really put together strong systems, strong processes in place to kind of make the process as simple as possible. We spend a lot of time internally on focused on dealing with friction points, just trying to make the process as smooth as possible for our borrowers, from kind of the underwriting stage through to advanced stage and completion, and then quick turnarounds of funds as well. This is something I'll highlight later in the presentation, but we've got our own internal construction inspector, and it really allows us to quickly get funds out to our clients, typically within 24 hours of that inspection we are able to get funds off to the clients for construction advances. So everybody knows time is money. The faster we can get funds to our clients, the faster the project gets completed, savings on interest rates and costs. So as far as rates and fees are concerned, so this is obviously a fluid situation, especially given the uncertainty in the marketplace right now. But I think this slide provides a pretty good high level of understanding of kind of what rates and fees we're looking at on first and second mortgages. So currently with first mortgages, interest rates average around 7.5% to 8.5%. And these are charged interest only. And one other thing to note here is construction loans do go out in tranches throughout the process. So the interest rate is only charged on the funds advanced and not charged on the total facility. So as funds are advanced throughout the process, that's what we charge interest on. The lender fees range between 1% to 1.5%. On construction loans, we typically charge a 1.5% lender fee, and that's charged on the total facility and collected typically off the initial advance. So for second mortgages, we're looking at interest rates between 9 to 10% interest only, and a lender fee of 2 to 3%. Our terms range between 12 to 24 months. We're a short-term lender. We're not looking at deals like institution would at like 5-year term. We're kind of in and out, provide funds for the construction to either sell the property at the end of the day or refinance with the bank. So we're looking at 12 to 24 month terms, and we find that a typical construction project from a good solid builder can be built in that time range. And one more note here is just construction loans. So all our construction loans are fully open, and basically that means that once the project is completed, if it's completed prior to the end of the term and it's sold or refinanced, there's no penalty to pay us off. So fully open, you complete the project early, sell or refinance, pay us off, no penalty. So this is another kind of fluid situation, obviously dependent on the underwriting package. But again, this slide provides a good general overview of our average loan to values for different types of projects here. So for land development, we're looking at 50 to 65% loan to value. And typically on land development, like we're looking for deals that once approvals are in hand, we have the ability to finance the construction of kind of the end project. So basically we try to stay away from high-rise development here because we do not finance high-rise construction projects, but anything from kind of a basic severance up to a zoning bylaw amendment or official plan amendment for a townhouse project, multi-unit project, low to mid-rise project, that's kind of the area we're playing in. Commercial and industrial project, 70% loan to value. For residential and residential lots, we're looking up to 75% loan to value. And for residential construction, I've kind of broken it down into two buckets here, new build construction and renovation. So the big situation here is for new build constructions, we have to take HST into consideration when it comes to our loan to values. And we do this because from our perspective, from an underwriting perspective, if we ever had to take over a construction loan, complete the construction and sell it, we'd be subject to the HST on sale. So that's something that we take in consideration, and we have to factor that into the loan to value calculations when looking at the numbers there. I'll review that later on when we're looking at how we structure a loan. And then if it's a renovation, majority of renovation projects, we don't have to take the HST into consideration. So we can lend 65 to 75% of the upon completion value. So just again, note that if it's a new build construction project, we do have to factor in HST to the loan to value calculations, and this can impact the dollar amount that our clients will receive. So what is construction financing? So really what it comes down to is we provide necessary funds to complete relatively capital intensive construction projects. So especially given the high construction costs we've seen lately, there's a lot of money involved with building out a construction project. So we're really bridging that gap from kind of the idea of what you're looking to build through to the sale or refinance. So our two main customers that we see are either a homeowner who is building their dream home or a builder developer building something on spec and looking to make a profit. And one more thing to note here is, although sometimes our clients may have the necessary assets to complete the projects, sometimes it's not capital efficient to liquidate some of those assets. There might be some tax implications of selling off assets to get enough liquidity to buy a home. So we really play that bridge, try to provide capitally efficient funds to complete the project. So this slide is just kind of looking at high level of what we're looking at from an underwriting perspective on a standard construction loan. So the three main categories we look at are project fit, builder experience / ability to execute, as well as covenant. So as far as project fit is concerned, like what we're really looking here is trying to understand what the demand for the property will be upon completion. So here we're trying to understand what our clients are looking to build, what's kind of the end value of what they're looking to build, how desirable is the subject neighborhood, is a product of that end value selling in that subject neighborhood, and as well as the project profitable. Like if we're looking at a spec project, does it make financial sense to build this out? So just a quick example here, like if we're looking at a $5 million home in rural Brampton versus core Toronto, obviously the demand for a house of that value in core Toronto is significantly higher than rural Brampton. So that would make a pretty significant impact as to how we're looking at the loan. We may shy away from a high-end home in a rural area, whereas something in core Toronto where other homes are selling for those values, we're comfortable moving forward with something like that. Next point here, builder experience and ability to execute. So we really just want to make sure that whoever's building the project, whether it's somebody's building for themselves and hiring a builder, or if somebody's building on spec and building themselves, we just want to make sure that they have the ability to execute. They've built similar type of projects in the past, and that they just have the ability to build what's being proposed. And then another point here is we are a professional lender, and we want to work with professional licensed builders. So we just make sure that our builders are, especially if it's a spec build, licensed with the Home Construction Regulatory Authority, and as well as the spec build if these homes are being registered as well with Tarion or the HCRA. And then the final point here, just credit worthiness. So do the clients have, I'd say the big thing here is financial wherewithal. Construction projects are extremely expensive, and typically there are cost overruns, especially now where project costs can be significantly higher at the end of the project than when the first initial budget is being put together. So we just want to confirm that our clients do have kind of aren't operating at the margin and do have kind of some back pocket to inject into the project if necessary. And then if a client's looking to build for themselves, we just want to make sure that they do have the ability to obtain takeout financing for the value of the home they're looking to build. So how construction loans are structured. So basically a loan facility is a percentage of the expected completion value of the project. So basically we go get a upon completion appraisal, which basically looks at the building plans, finishes, etc., and finds market comparables, similar market comparables, and comes up with an end value. And we take a percentage of that end value to come up with our loan facility. And that loan facility is actually broken down into multiple components. So you have acquisition funds, and these funds are used to either acquire the property or pay off the existing financing. And then you have components for soft costs and hard construction costs, and those are used to finance the costs of the project and advance on a work in place cost complete basis, which I'll dig into on the next slide. And then typically our facilities also have an interest reserve built in, which is used to service the debt payments throughout the term of the loan once the construction has begun. So construction advances, this is also a situation where we've got something like a pretty simple basic system in place, but from a high level perspective here, all construction funds are being advanced on a work in place cost complete basis. That means basically our clients begin work on the project and we can advance funds for work that has been completed to date, confirm work that has been completed. So really simple process here. Basically, we've got internal Excel spreadsheet budget, and prior to any funds being advanced, we pre-agreed to a construction budget. So the client fills in our budget template. We review it internally to make sure it's sufficient to build out what the proposed project, and we pre-agreed it on that stage, and that's the budget that we're going to use for the construction advances. So once that's pre-agreed upon, the client closes on the property and begins construction on the project. Once there is sufficient work in place, the borrower will request an inspection. And once an inspection is requested, we will basically send our internal inspector out to the site with a copy of that pre-agreed upon budget, and it'll basically complete a walkthrough of the property and just confirm that the work is completed in good working manner. And basically, once that inspection is completed, that evening we receive a inspection report, a one-page simplified inspection report, just kind of letting us know what work has been completed to date and the new work in place. And once we have that, within 24 hours, we can advance the funds for that work in place. So very simple process, pre-agreed a budget, start the work. We'll send our inspector out to the site when you're ready, and then we can advance funds based off of the work that's been completed. So just highlighting some of the benefits of our construction process. So first one here, there's no percentage completion thresholds and no limit to the number of draws. So some of the other lenders in the construction space will have a fairly stringent lending construction advance kind of template where they're looking for 20, 40, 60, 80, 100% threshold before you can get a construction inspection in advance. We don't have any thresholds in place, and there's no number no limit to our number of draws. There is a cost associated with each advance, so we do recommend our clients have sufficient work in place before requesting inspection, but we don't have that necessary. Like if the project's only 15% complete, there's no kind of 20% threshold that needs to be hit. We can send our inspector out to the site. Next major point here is we do have our own internal inspector for construction projects, and basically it's any stick build project, we use our internal inspector, and this is really big on saving time and money because we can get our inspector out relatively quickly to your site, and it doesn't we don't get the 150-page report that a typical quantity surveyor will provide. So we're really able to turn funds around. Our inspector has been doing construction advances for inspections for us for a long time, really understands the kind of infill construction product and is really knowledgeable in that space as well. So again, quick turnaround of funds. I mentioned this before, but basically once we have that inspection report, typically we can get funds out to our clients within 24 hours. Again, time is money. The quicker you can get the money, the quicker you pay your trades, the less interest costs at the end of the day. And then final point here is just simplified advanced process. So we spend a lot of time internally trying to reduce friction points. And this is one of the key areas, I think, here where we're not going to require all the invoices, paperwork on each advance. As long as we can see the project is moving along and new work is being put in place, that's enough. It really lifts quite an administration burden off our clients, and kind of it allows them to access funds, get advances on a much faster basis, not having to kind of organize and put together all that paperwork for an advance. And one other thing I'll mention quickly here, it's on this slide, but just regarding deposits. So we are able to advance deposits on projects. This is more of a relationship-based situation. So if we're not going to advance big deposits up front on a project, but if things are moving along well and you're on your third or fourth advance and you're looking for a kitchen deposit, like we can, as long as you provide us an invoice, we're able to provide funds up front for those types of situations. So I'm just going to run through a quick loan example here. So in this situation, we've got builders looking to purchase property and build a new 2,500 square foot single family home. This is a very kind of straightforward single family home type project. So in this scenario, the purchase price is $900,000 to acquire the property. The construction budget is $800,000, and the expected end value is $2.5 million. So just as far as how we would structure this facility. So again, as I mentioned earlier, we structure our facilities as a percentage of the end value. Since this particular scenario, this is going to be a new build. So we're going to lend a percentage of the end value net of HST. And in this situation, and typically on average, we're around 70% of the end value net of HST. So 70% of the $2.5 million comes out to 1.56 million. And this is calculated if you take the end value of $2.5 million, add on the $24,000 HST rebate and divide by the 1.13, you'll get the net of HST value, which comes out to approximately 2.233 million. And then we're taking 70% of that figure, and that's how we get the 1.56 million. And this 1.56 million is broken down into various components as mentioned before. So we're going to provide acquisition funds to purchase the property of $675,000, which equals 75% of the $900,000 purchase price. We're going to provide construction costs of $800,000, which, as you can see above here, would be 100% of the project hard costs from this scenario, as well as an interest reserve of $85,000. And just remember, as far as the interest reserve is concerned, this is just an approximate calculation of the interest costs over the term of the loan. Since construction loans go out in tranches, there's no exact calculation. It's just dependent on when funds are drawn and how much is drawn. So this is just kind of an approximate calculation as to, based on an average draw schedule, how much we believe the interest cost will be. And just one more quick thing to note on the interest reserve. Typically, we only tap into this once the construction funds begin to be drawn. So from acquisition to the initial construction draw, the clients are going to service the interest on that $675,000 out of pocket. And once the construction draws occur, we can begin tapping into that $85,000 interest reserve. So this is going to be an example of the initial advance for the property. So this would be for the acquisition of the property. So we said we're providing $675,000 to acquire the property, which is 75% of the purchase price. And this is kind of a breakdown of what the advance sheet would look like. So we've got $675,000 advance, less a 1.5% lender fee on the total facility. So that's 1.5% fee on the 1.56 million. Net of the standby fee of $7,000. So we collect that upon issuance of the commitment. So when you sign back the commitment, we're going to collect that $7,000 standby fee, and it's netted out from the lender's fee on that initial advance. And then we've got, well, in this scenario, there's no broker involved, but there could be a broker fee. We've got a legal fee, which is a 1/4 point of the total facility. And then you're going to have title insurance as well. This was just an estimate, obviously, based on the loan amount. So you can kind of see that the $675,000 total advance will net out to approximately $650,000. So in this scenario, if the property is being purchased for $900,000, the client's going to have to come up with approximately $250,000 to close. Plus, there are other closing costs involved, of course. So the client will have to pay the land transfer tax, the client's legal fees. So that 1/4 point is to cover foremost legal fees. The client will have their own legal fees. We require builders risk insurance on all our projects, and I'm going to just mention that later on, but that will be a cost as well there. And there are some other miscellaneous underwriting costs as well, such as appraisal fees, budget consultants, and etc. So this is, so now the project has been purchased. The client has started construction of the project, and they've gotten in contact with Foremost for the initial construction advance. So in this example here, I assume that we received the inspection report and confirmed that $150,000 of construction work has been completed on site. So this is an overview of what the construction advance would look like. So we've got hard construction costs in place of $150,000, and we've also now began advancing the interest reserve, which is basically on each advance, we basically project out how much interest we'll be owing until the next expected construction draw, and we'll advance that figure. So those are the dollars we're advancing, and then we deduct back out the interest reserve, and basically it's because we're paying it out to our clients, and then we're just holding it back to pay the interest instead of paying it out to the clients and then them sending us a check for the monthly interest costs. We hold back as well 10% of the hard construction costs in place for the lien holdback. And that's because as per the Construction Lien Act, we are required to hold back 10% of these costs as they're put in place and as we put the money out. And basically, again, I'm going to dive deeper on a further slide here, but basically these funds are held back until 60 days upon substantial completion of the property. So once the property is substantially completed, the 60-day ticker begins, and once we've hit the 60-day mark, we can advance the 10% holdback there. So in this scenario, because of the construction budget and the construction funds in the facility were the same, there's no equity requirement, but in the next slide, I'm going to go through an example where there is an equity requirement. And then the final point here is just the advance fees. So as I mentioned before, there is a cost associated with each advance. It covers our inspector's fee, our admin fee, as well as our legal fee per advance. So it's approximately $1,250. Again, that's just an estimate. It varies from advance to advance. But as you can see here, the total deductions are $22,000 from the $150,000 plus the interest reserve, and the client would net out just over $133,000 in this scenario. And basically how it works from here is the client would take those funds, reinvest them into the project, and then once they have sufficient work in place, they'd call us for another inspection and kind of rinse and repeat this cycle until the project is completed. So in this scenario, and this is something we're seeing quite a bit more often these days, is given the increase in construction costs, sometimes the amount of funds that we can provide given our facility based off of the end value doesn't line up directly with the construction budget. Sometimes there's a delta there, and the construction budget is actually higher than the construction funds that we can provide. And that again, just going back to how funds are advanced on a work in place cost complete basis, we always need to make sure that there's enough money in the facility to complete the project. And in this specific scenario, if there's $850,000 to complete the project, we only have $800,000 in our facility for construction funds, it creates a $50,000 shortfall. And this shortfall has to be injected again at the beginning of the project, so we can always maintain enough money in the project to complete it. So this is the exact same scenario as the previous slide, other than there is that $50,000 equity requirement, which reduces the amount of money they're receiving on that initial advance to just over $83,000. Once that equity requirement is covered in that initial advance, on a going forward basis, we can advance 100% of those hard costs, but it does need to be injected into the project up front. And again, same situation, client gets the $83,000, they reinvest that into the project. Again, give us a call when they're ready for the next inspection, and on a going forward basis, the equity requirement has been wiped out, and we can provide 100% of the hard costs less the 10% construction lien holdback. So I think this is a really important slide. I'm just going to quickly highlight some of the construction specific practices and intricacies of construction loans. And again, these spend a lot of time on friction points, but we do find that this is some of the some really important basic information and knowledge on construction financing to understand from our client's perspective, because we do see some friction points arise from these situations, and it's really just understanding knowledge type thing. So first of all, the LTV net of HST on new builds. So once again, if it's a new construction loan, because even if the client's building for themselves and technically they're planning to move into it and there wouldn't be any HST at the end of the day. From foremost perspective, we need to take this into consideration, because if we took over any project that we're working on and finished it and sold it, we'd be subject to HST. So it's important to consider, because on new construction projects, it's potentially significantly less money you can get out of the project. So if you're looking at 70% loan to value net of HST, this really comes out to around 62-63% loan to value there. So it's just important to take into consideration just understanding how much money you're going to see in the project. Advances on a cost complete workplace cost complete basis. So once again here, we aren't advancing funds at the beginning of the project for construction. The client needs to put the work in place, get the project going, and then we can advance based on that work in place. Potential equity requirement, I mentioned on the last slide, if there is a mismatch between the facility and the cost to build out, that money needs to be injected up front. The construction lien holdback, so this is another important situation here. So with the construction lien, we are required to hold back 10% of all construction hard costs, and those funds can't be released till 60 days after substantial completion. And it's just important to note that as you're going through the project, if it is an $800,000 construction budget, like technically throughout the term of the loan, you will be required to cover that 10%, the $80,000. So it's just important to keep in mind. And on our construction projects, 60 days after substantial completion. If it's a larger project and there is a quantity surveyor involved, so like a large town-owned project or a small to mid-rise project, we can look at advancing the lien holdback 60 days after the trades have completed the project, but there's a lot of paperwork involved with that, so we really simplify the project process for the majority of our projects, and we hold it off till 60 days on substantial completion. And the last point here is just builder's risk insurance. So we require this on all our infill construction projects, and this basically just covers us, whereas we're lending on the structure as construction progresses, and if there's any damage, fire, flood, etc., it just basically covers us in those scenarios for the loan amount advance. And for builder's risk, the important thing to note here is that we are looking for a policy in the amount of the construction budget. So just last couple of slides here. So these are the typical construction loans that we see here. So our real bread and butter type deals are the single family infill custom homes. We see a lot of extensive renovation projects, especially in core Toronto, where clients are doing full guts of a property, multi-unit single family construction. So whether that's severance and construction of 2 to 3 new homes, small apartment construction. This is also something we see quite a bit in the Toronto area, where people are buying older homes and converting them into duplexes or triplexes and retaining the properties. Townhouse development, we really like these types of projects. Like our specialization is in stick builds, and townhouse developments are really stick builds, but on a larger scale. So we're trying to push for more of these types of projects. We really like working on townhouse type deals. And then low to mid-rise condo development. So this is where you get a bit more complex and more of a concrete type structure situation, but we've got the ability to get those done. And pre-construction land development, so including site servicing and apartment bridge financing, something we've seen quite a bit recently as well, where we'll go in for the acquisition, the turnover of units and the value add renos. And then the clients will refinance with a significantly higher NOI with CMHC type financing. And so that other slide was focused on the construction side, but we do look at tons of different types of special situations loans. So whether it's land development specifically, bridge financing, repositioning assets, environmentally contaminated property. So here we'd be looking at trying to determine what the cost to remediate is and kind of netting it out from the total facility. Debt restructuring as well. As I mentioned earlier on in this presentation, like we've got a lot of internal expertise So we can really come up with some interesting creative solutions for special situations. I'd say the biggest thing here is an exit strategy. Again, we're short-term lenders, so at the end of the day, we're looking for how do we get out of the loan 12 to 24 month period? What's the story, and what's the exit strategy at the end of the day? Those are kind of the two most important factors there. So this is the last slide here. So just getting deals to the finish line. So biggest things here. So understand the project. So understand values upon completion. What are the project plans? What are you looking to do? What's the demand in the neighborhood? Who's the builder? What's kind of the client's financial wherewithal? Do they have the ability to cover cost overruns? Basically what we discussed in the underwriting slide. Understand the lender. So rates, LTVs, what we discussed in that previous slide. And basically, like if you're looking for a 5% interest rate at a 90% loan to value, it's not something that's not a market we operate in. So it's probably not even worth the conversation there. Understand the lender's process. So again, the slides on loan structure, advanced process, understand how loans are structured, how much money you can expect, and then how the money will be advanced throughout the process. And then the big thing here is invest time in a complete package. Like the more complete a package we can get off the bat, the quicker we can make a decision, the quicker we can move things forward. So that, again, that goes back to answering the questions in that underwriting slide. So final point here is just if you have any questions, if you're looking to discuss any deals, like feel free to give us a call anytime, whether you can reach out to myself, or if you already have a contact at Foremost, like we're always willing to discuss, listen to deals, or answer any questions. So please feel free to reach out. So that's the end of the presentation. Hopefully, again, provided a pretty good understanding of construction financing. We'll open up just some questions here. I see we've got a couple already, but again, if you do have any specific questions or want to discuss any specific details, deals, please feel free to reach out here, with my contact information on this slide. So let's quickly get to some questions here. So the first question is whether we will finance 100% of the hard costs. And so again, it comes down to the situation with the loan facility. So we can finance up to 100% of the hard costs, but it depends on what the end value is and how we structure the loan. So if there is enough equity in the situation to finance 100% of the hard costs, we can go up to that. But again, we structure the facility as a percentage of the end value and then kind of work our way backwards. So we've got the ability to do that, but it just depends on the end value, what percentage we're willing to lend, and then how much you need for the acquisition of the property, what the construction budget is, and then factor in the interest reserve in there as well. Okay, next question here, maximum loan amount per project. So I think I mentioned this earlier, but our typical maximum loan amount is around $20 million mark, but we can explore loans up to the $30 million loan facility. So I'd say internally we're maxing out at $30 million, but obviously it depends on whatever the specific situation is with that loan. This one is just on our interest rate. So there is a slide on our interest rates that we discussed. It's a fluid situation. Obviously, there's a lot of uncertainty out there, but I'd say on first mortgages right now, we're averaging between 7.5% and 8.5% with on construction loans at 1.5% lender fee, and on second mortgages, we're looking between 9 to 10% interest rate with the 2 to 3% lender fee, and obviously highly dependent on the underwriting package and the specific deal. Okay, so the next question here, if project needs minor variance, it needs to be done, construction loans be done before getting city approval. So yes, we typically actually do try to structure the total facility and include even at the stage of minor variance at the planning stage, and this actually saves costs for a client as far as kind of legal fees, re-registering loans, lender fees. So we do, if something needs to be taken through the planning process, I guess it kind of depends on how long that process is. If it is just minor variances, yes, it does make sense. We will structure a total facility at the beginning, and then again, we can advance funds for the acquisition up front. Once the acquisition occurs, the purchase occurs, and then after the minor variances are received from the city and construction begins, then we can move into the construction portion. So we do put it all into one facility and then kind of advance funds as the loan moves along. Okay, do you accept appraisal evaluations based on residual value approach, proposed density of the unzoned property, of what LTV lend can you lend on? So typically we don't like using a residual value approach. We typically like using comparable approach because there's a lot of variables and assumptions in a residual value approach. So we like kind of lending on whether if it's pre-development, looking at other pre-development properties at similar stages and what they sold for. So definitely prefer the comparable method in that situation. And as far as what loan to values we can lend on typical land development, we're looking at 50% to 65% loan to values. And as I mentioned before, we typically like to focus our land development on properties that we can finance the construction of. So whether it's kind of ranging from multi-unit, single family, townhome, or low to mid-rise type projects. We stay away from the high-rise construction because we don't finance those types of projects on the construction end. Somebody's requested a hard copy of this presentation. So yeah, we can send out a hard copy of the presentation to everybody who registered and attended this event. We'll also try to make it available through our website as well. Okay, so here's a question on the lien holdback and interest reserve issue. So just diving into that here quickly. So on the lien holdback, so basically the Construction Lien Act reads where as a lender, we have to hold back 10% of all construction costs in a project. So basically, if the total construction costs are, again, in our example, 800,000 throughout the project, we have to hold back 80,000, and it's done on as the funds are drawn. So initial advance of 150,000, we're holding back 15K of that, and that gets held back on each advance. And basically the way we operate for, again, the majority of our projects is that these funds are advanced 60 days after substantial completion of the project. So throughout the construction project, we're holding back 10%. Once our inspector deems the project substantially completed, we start that 60-day countdown. And once we hit those 60 days, we have the ability to advance those funds. In those situations, it's typically for people who have are either listing a property or sold the property and waiting for the property to close, or are refinancing with the property and waiting for the banks to pass off. And we basically use those funds at the end of the day just to service debt for those periods. So we don't necessarily, those funds don't have to be advanced, and there's no interest charged on the held back funds. But we typically see on our projects that after those 60 days, typically the interest reserve has been completely utilized, and we advance those the lien holdback funds to service the interest until the project is completed or sold by our clients. So again, 10% of all hard costs, clients got to cover those funds out of pocket throughout the construction process, and then at the end of that period, we could at 60 days after substantial completion, we could advance those funds, typically used for servicing the interest costs until the loan is paid out or refinance. And just as far as the interest reserve is concerned, like we typically build into all our construction loans an interest reserve, and this is again used to service the debt costs throughout the construction process. And I mentioned it earlier, but there's no exact amount of interest for a construction loan because the money goes out in tranches and there's no exact timeline to advances or the amount of advances. So we calculate an approximate interest reserve, and then on each construction advance, we'll advance a portion of that interest reserve to cover what the expected interest costs are to the next advance. Typically, construction advances are happening every 1 to 2 months on our projects. So we'll say, okay, we're doing an advance today. Given this current advance amount plus what we previously advanced, the interest costs for 1 month will be X amount of dollars, and we'll advance those funds from the interest reserve to be used to cover those payments. The last question here is no advances process, so no interest is charged. So I think what this question is trying to ask is basically we only charge interest on the funds advanced. Once again, construction funds go out in tranches. So if the total facility is $1 million and we've only advanced $500,000 to date, the monthly interest payments will only be on that $500,000. So if we're looking at an 8% interest loan, the interest charge on a monthly basis will be 8% of the $500,000 divided by 12 to come up with the monthly calculation. So so interest is only charged on the funds advanced. However, the lender fee is charged on the total facility and collected upfront off the initial advance. We'll just keep it open here, see if there's any last minute questions. So it doesn't look like there's anything else here. Again, if anybody does have any questions or there are a couple more here on the chat. Just open this. Back to the equity issues. So this is a question from Walter regarding, again, the equity. So if there is enough room in the facility, and again, we'll finance a maximum of 75% of the as-is value on an infill construction project, a residential infill construction project. If there is enough room in the facility, so the end value is able to cover, a percentage of the end value is able to cover 100% of the hard costs. We are able to finance 100% of the hard costs. I've got to say that on a lot of stuff we're seeing recently, given the high construction costs, the increased construction costs, like it's typically we are seeing a lot more situations where an equity requirement is needed to be injected in the project, just because construction costs are going up so quickly. So if we can fit it all within the facility, yes, we can finance 100% of the hard costs, but it just depends on kind of the values and the money needed for the project. So regarding substantial completion, so the way we work on that for our lien release is basically once our inspector deems the project substantially completed, I think it's like only 2 to 3% of the construction costs remaining, somewhere in that range. We can deem the project substantially completed, and we can start the lien clock there. So we don't need an occupancy permit for that. It's more from a construction completion perspective. So here's a question on the interest. So the interest is compounded on a monthly basis, but it's also charged on a monthly basis. So it's interest only. Our clients will receive a mortgage statement, an interest statement on a monthly basis showing how much they owe for the beginning of that month. If they don't make that payment at the beginning of the month, then interest is compounded. And We do have some flexibility as well as far as interest payments are concerned. Like if it is a construction project and the client is expecting a draw within kind of the first 15 days of the month, first 15 to 20 days, and there's an interest reserve, then like we don't require a payment immediately on that first day of the month. We're okay with, we've got some flexibility there to wait to the 15th day when that construction draw occurs, and then advance the funds at that point with the interest reserve to cover the interest costs. Okay, I think we've just got a couple more through the question Q&A. Okay, I think that's it for the questions there as far as I can see. So once again, if you have any follow-up questions, any specific questions, feel free to reach out directly with my contact information here. We'll try to distribute a copy of this report to everybody who attended the call today. So thanks everybody, and have a great day. And again, yeah, if you got any specific questions, be in touch. Take care.